IND AS 8, Accounting Policies, Estimates and Errors, the backbone of consistency. Hello, and welcome to Candymentor. In this session, we'll unpack IND AS 8, the rulebook that keeps financial reporting consistent across periods. You'll learn how to choose and change policies, revise estimates correctly, and fix prior period errors the right way. Objective of IND AS 8. The standard exists to protect users from misleading numbers. It tells us when to change an accounting rule and when to update an estimate or correct an error. Its goals are simple. Select sound policies, apply them consistently, and disclose changes transparently. This prevents management from engineering profit through selective timing or methods. Scope and coverage, IND AS 8, applies to every entity preparing financial statements under IND AS. It covers three pillars: accounting policies, accounting estimates, and prior period error corrections. It does not cover measurement rules that belong to other standards, and first-time adoption issues are handled by IND AS 101, not here. Key definitions. Let's define three core words plainly. Accounting policies, the specific principles, methods, and conventions you use. Accounting estimates, the judgments that change amounts when new info arrives. Errors, omissions or misstatements from mistakes, oversight, or fraud. Keep these meanings tight. They determine whether you restate past numbers or just move forward. Accounting policies, meaning and purpose. Accounting policies are the how of reporting. They decide recognition, measurement, and presentation for transactions. Examples: revenue recognition method, inventory valuation, FIFO versus weighted average, and depreciation method. Good policies produce comparable results across time and across peers. Selection of accounting policies. Start with IND AS guidance if it exists. If no explicit rule, use similar IND AS, the conceptual framework, and consistent industry practice. Always pick policies that give faithful representation, relevance, reliability, comparability, and understandability. Management must document why a chosen policy best reflects the economics of the transaction. Changes in accounting policies. When allowed, you can change a policy only when 1. A new or amended IND AS requires it, or 2. The new policy gives more reliable and relevant information. You cannot change policy for convenience or to influence profit. Example: switching to the revaluation model under IND AS 16 is allowed when it fits the asset and standard. Accounting treatment, policy changes. When a policy changes, apply it retrospectively, unless an exemption exists. That means adjust opening balances for the earliest period presented. Restate comparative figures so users can compare like with like. If restatement is impracticable, apply the change from the earliest practicable date and disclose the limitation. Retrospective application explained. Retrospective application means apply the new policy as if it were always used. Adjust prior period numbers and opening equity accordingly. This preserves comparability across the presented periods. If you truly cannot determine the effect after reasonable effort, explain why and apply prospectively. Amen. Disclosure for policy changes. Disclose clearly and concisely the nature of the change and why it improves relevance or reliability, the amount of adjustment for current and prior periods. If retrospective application was impracticable, explain the reason. Also cite the IND AS that required the change, if applicable. End. Changes in accounting estimates. Definition. An estimate changes when new information or developments affect your judgment. Examples: revising useful life of an asset, changing warranty obligation estimates, or updating fair values. This is not an error. It is management revising its best estimate based on new facts. Accounting treatment. Estimates changes in estimates are applied prospectively. They affect the current period and future periods only. Do not restate prior year figures. Example, revise remaining useful life from 5 years to 3. Update depreciation going forward, not backward. Key difference: policy versus estimate. Keep this comparison in your head. Policy equals a rule or method. Estimate equals a measurement judgment. Policy changes, retrospective effect. Estimate changes, prospective effect. Example, switching inventory method is policy change. Revising spoilage percentage is estimate change. Disclosure for estimate changes. Disclose the nature of the estimate change. Quantify the effect on current period profit or loss. Where possible, give expected impact on future periods. If you cannot quantify, describe qualitatively why and how it affects results. Errors, definition and nature. Errors are mistakes in prior period financial statements. They can come from arithmetic slips, misapplied policies, oversight, or even fraud. When discovered, treat them as prior period errors, not as estimate changes. Correcting them improves reliability and user trust. End. Correction of errors. Treatment correct prior period errors retrospectively by restating comparative amounts for each prior period presented and adjusting opening balances of assets, liabilities, and equity for the earliest period presented. If restatement is impracticable, correct from the earliest practicable date and fully explain why you could not restate. Examples of prior period errors. Typical examples include missed accruals for expenses or revenue, omitted depreciation charges, incorrect classification of a capital item as revenue, or discovered fraudulent overstatement of income. These require restatement, not a simple footnote. Disclosure for prior period errors. Disclose the nature of the error. Quantify the correction for each prior period presented. Show the effect on opening retained earnings for the earliest period restated. If EPS, basic or diluted, is affected, disclose the impact. If restatement was impracticable, explain why. Materiality and impracticability. Materiality decides whether an error or change matters to users' decisions. Impracticability means you cannot determine the amounts after reasonable effort. Example, lost historical records prevent reliable restatement. That can be impracticability. But don't invoke impracticability lightly. Document the attempts and rationale. So be sure to document them. Interaction with other standards. IND AS 8 links to other standards often. IND AS 1 for presentation and comparatives. IND AS 10 when an event reveals a prior period error. IND AS 37 for estimates relating to provisions. IND AS 12 for tax effects on rule-stated items, and IND AS 101 for first-time adoption adjustments. Journal entry illustration. Here are practical journal flows you'll use. Change in estimate, prospective. Doctor depreciation expense. Credit accumulated depreciation. Correction of prior period error, retrospective. Doctor retained earnings. Opening balance, credit, asset, liability, expense, as applicable. Change in policy, retrospective. Doctor retained earnings, opening balance, credit, related asset, liability. Always narrate entries clearly. Explain the reason and the period affected. Numerical example, change in estimate. Asset cost, 10 lakh rupees. Original useful life, 10 years. Depreciation 1,000 rupees per year. After 5 years, revised total useful life becomes 8 years. Carrying value at revision 5,000 rupees. Remaining life 3 years. New depreciation 1,667 rupees per year. Apply this prospectively for the remaining years. Numerical example, error correction. Previous year omitted revenue, 2 lakh rupees. Discover it before financials are approved. Action, restate prior year comparative figures. Adjust opening retained earnings for the earliest year presented. Disclose nature, amount, and effect on EPS if applicable. Thank you. Common pitfalls. Avoid these common mistakes. Treating an estimate revision as a policy change, which causes unnecessary restatements. Failing to restate prior comparatives for errors. Claiming impracticable without sufficient attempts to compute restatements. Not quantifying the impact of estimate changes or errors when material. Disclosure checklist. When you change policy, estimate, or correct an error, disclose the nature of the change and the reason for it, the quantitative effect on each period presented, the method of application, retrospective or prospective, and, where impracticable, an explanation of why restatement was not possible. Article in the bottom of the case. Closing summary, IND AS 8 protects comparability and credibility. Policy equals principle, change and restate retrospectively. Estimate equals judgment, change prospectively. Error equals correction, restate prior periods and adjust opening balances. Document everything. Quantify impacts and disclose fully. Master IND AS 8 and you master the discipline behind honest, repeatable financial reporting. Final takeaway. IND AS 8 is the backbone of consistent accounting. It prevents history from being rewritten for short-term advantage. Every change must be justified, documented, and transparent. Do that, and your financials will remain reliable and trustworthy.